Everyone assumes the biggest market moves announce themselves loudly. But I've learned, sometimes the hard way, that the most powerful shifts arrive in silence, and that's exactly what makes this moment so dangerous. And so full of opportunity. Right now, I feel that familiar tension in the background, the kind that shows up when something important is forming, but it's not yet visible on the surface. Markets look calm, headlines are distracted, and most people are focused on what has already gone up, instead of what is quietly being ignored. And from an investment and business perspective, this is always the phase where conviction is built, not profits. When I look at silver today, I don't see excitement, I don't see hype, I see hesitation, neglect, disbelief. And those are the exact conditions that have historically preceded the most aggressive repricings, because when an asset stays suppressed for too long, when capital avoids it because it feels boring or outdated, pressure builds invisibly. We don't notice it because nothing dramatic is happening yet. But under the surface, supply constraints, structural demand, and monetary realities begin stacking on top of each other. And in my experience, markets don't move gradually when this happens. They snap. That snap is what I mean by a silent storm. No warning siren, no countdown clock, just one sudden moment where the old price stops. Making sense, and for investors, that's the moment that tests discipline and patience, because it's uncomfortable to position early. There's no validation from the crowd, no reassurance from rising charts. Business decisions made in this phase feel lonely. We allocate capital, adjust strategy, or hedge risk, while everyone else tells us we're wasting time. But I've seen what happens when we wait for confirmation. By the time the move is obvious, the advantage is gone. The quiet phase is where asymmetric opportunity lives. Downside is limited by neglect. Upside is amplified by surprise. I'm motivated by the idea of being prepared rather than reactive, of building positions and strategies when the cost of being wrong is low. And the reward for being right is disproportionately high. We don't need silver to be popular, we need it to be mispriced. Because mispricing never lasts forever, especially in an environment where trust in financial systems is fragile. And capital is searching for stability beneath the noise. From a business mindset, this is about anticipating shifts before they disrupt balance sheets, supply chains, and purchasing power. If we wait until the storm is visible, we're already in damage control, not strategic positioning. And right now, the calm is misleading. It lulls people into inaction. And I don't want to be one of those people who looks back and says, the signs were there. But I ignored them because nothing felt urgent. Urgency doesn't always announce itself. Sometimes it whispers, and when it comes to markets that move suddenly, it's the people listening in the silence who are ready when the storm finally breaks. Now, what deepens my conviction is how clearly the broader economic environment keeps pointing in the same direction. Even when most people refuse to connect the dots, when I step back and look at the system as a whole. Debt levels, monetary policy, currency stability, geopolitical stress, I don't see a healthy equilibrium. I see strain being managed, postponed, and masked. We've built an economy that depends on constant intervention, and every intervention has a cost. Interest rates rise, then something breaks, liquidity tightens, then it quietly reappears under a different name, and this cycle matters, because over time it erodes confidence in paper, promises, and strengthens the long-term case for real, scarce assets. I don't need a crisis headline to recognize purchasing power is being diluted. I see it in operating costs, in capital planning, in the way businesses struggle to forecast even 6 months ahead. When uncertainty becomes structural rather than temporary, capital starts seeking safety, whether people consciously admit it or not, and this is where silver becomes a serious conversation, because it sits at the intersection of monetary protection and economic utility that makes it uniquely sensitive to macro stress. I don't see it as just a trade, I see it as a response to a system that is increasingly fragile beneath its polished surface as debt expands faster than productivity. And currencies are managed rather than trusted. Hard assets quietly regain relevance. What motivates me is understanding that these forces don't unwind slowly, they reach tipping points, and when tipping points arrive, institutions don't move gradually. They move all at once, and that compresses years of price adjustment in 2 months. Sometimes even weeks. Ignoring macro stress because markets appear stable is one of the most expensive mistakes people make. Stability built on leverage and confidence is inherently fragile. Businesses hedge against supply risk, currency exposure, cost volatility, not because disaster is guaranteed, but because resilience matters. Silver, in that sense, represents optionality, a hedge against policy error, a hedge against inflation surprises, a hedge against the slow erosion that feels normal. Until it becomes irreversible. I don't approach it with fear, I approach it with realism. We don't live in a world of clean balance sheets and disciplined monetary restraint. We live in a world where debt solves today's problems by borrowing from tomorrow, and tomorrow is arriving faster than most portfolios are prepared for, so we can pretend these imbalances don't matter, or we can position for the consequences they eventually produce. I choose positioning, not because timing is perfect, but because direction is clear. When macro pressure builds long enough, it expresses itself somewhere, and historically it expresses itself through assets that cannot be printed, cannot be diluted, and cannot be restructured away. Silver doesn't need optimism to perform. It needs stress, and stress is no longer hypothetical. It's embedded into the foundation of the system we're all operating within. Now here's the next layer that makes this even more interesting. When I analyze silver more deeply, what stands out is how distorted its relative value has become, especially compared to assets investors treat as monetary anchors. I keep asking myself, why have two metals that have historically served similar roles in preserving value drifted so far apart in perception and pricing? And the answer isn't fundamentals disappearing, it's attention shifting. Capital always chases what feels safe and validated, and it abandons what requires patience and independent thinking. But from an investment perspective, that divergence isn't a warning, it's an invitation. Because when ratios stretch beyond historical norms, they don't stretch forever. They correct, sometimes slowly, but very often violently. Silver's undervaluation isn't the result of irrelevance, it's the result of narrative neglect. It's been framed as too volatile, too industrial, too inconvenient. But markets don't price narratives forever. They eventually price reality, and silver's reality is that it plays two roles at once. It behaves like a store of value in monetary stress, and like a critical industrial input when economies expand. That combination is rare. And it's exactly why prolonged undervaluation creates powerful setups. In business terms, it's like finding an asset with growing demand and constrained supply that the market temporarily wrote off because it wasn't fashionable. No serious business would ignore that opportunity. Yet investors do it every day with silver. I'm motivated by the idea that relative mispricing can matter more than absolute pricing. An asset doesn't need to be cheap in isolation. It needs to be cheap relative to what it should be priced against. And when that gap closes, it doesn't close politely, it compresses quickly. As capital rushes in to rebalance exposure and hedge risk, we've seen this pattern repeat across cycles. Assets ignored for years suddenly become essential overnight. The discomfort here is psychological, not analytical. It's hard to invest when nobody's looking. It's even harder to hold conviction when progress feels invisible. But markets reward patience only when it's paired with sound reasoning, and silver's undervaluation is structural. It's driven by paper markets, financialization, and the prioritization of assets that fit neatly into modern portfolios. That structure works, until it doesn't. Because when trust shifts and risk is reassessed, relative value becomes impossible to ignore. From a strategic standpoint, I don't view this as a bet against other assets. I view it as balance. Over-concentration in one narrative creates vulnerability. Silver offers diversification not just in allocation, but in logic. It responds to forces many portfolios are underexposed to, and we don't need to predict the exact day the imbalance corrects. We just need to recognize that imbalances this large rarely resolve quietly. When the market finally reconciles silver's role with its price, the adjustment can reflect years of neglect, compressed into a short window. Being positioned before that realization isn't speculation. It's respecting historical patterns, economic reality, and the inevitability of mean reversion when value is ignored for too long. Now there's one more layer here that adds urgency. The physical side of this market is far more fragile than most people realize. On paper, it's easy to assume production can increase if prices rise, but in real business terms, that assumption rarely holds. Mining is capital-intensive, time-consuming, exposed to regulation, environmental pressure, and geopolitical risk. New supply doesn't appear because investors suddenly want it. It appears years later, if it appears at all. And silver has a unique vulnerability. Much of its supply is produced as a byproduct of mining for other metals, which means supply is not responsive to silver prices alone. That's critical. Even if silver rises, miners can't just flip a switch and flood the market. Meanwhile, industrial usage keeps expanding. Technology, energy infrastructure, manufacturing efficiency. Silver is embedded into systems modern economies depend on. That demand is sticky, it's not optional, and once it's built into production chains, It doesn't disappear easily. From a business standpoint, this is a recipe for vulnerability. Any disruption, labor shortages, energy constraints, logistics failures, policy changes can ripple through supply chains fast, and silver sits right in the middle of that fragility. This is the part most financial models underestimate. Physical scarcity behaves differently than financial scarcity. You can create more paper claims, more derivatives, more promises, but you cannot instantly create more metal. And when physical demand collides with limited availability, pricing mechanisms break down instead of smooth adjustments. We get sharp moves. Buyers compete for what actually exists. That's when markets snap. You don't need mass panic for this to happen. You only need a modest increase in demand, or a minor disruption in supply, to expose how tight the market really is. From my perspective, this isn't speculation. It's respecting physical reality. Markets can ignore scarcity for a long time, but they can't ignore it forever. And when they're forced to acknowledge it, the adjustment is rarely gentle. Now here's what concerns me the most, and at the same time reinforces my resolve. Most investors and businesses look completely unprepared for a shift like this. Typical portfolios are heavily concentrated in assets that depend on stability, liquidity, and confidence in the system, and there's nothing wrong with growth exposure. Until conditions change, the issue isn't the assets, it's the assumption. We've been conditioned to believe diversification means owning variations of the same underlying risk, assets tied to the same system working smoothly, as long as trust remains intact. But when stress enters the system, correlations rise, exits narrow, and what looked diversified starts moving together. That's when preparation stops being theoretical and becomes practical. Being unprepared doesn't mean lacking intelligence, it means being anchored to narratives that worked in the past, and assuming they'll continue uninterrupted. I've seen how quickly sentiment flips, how fast liquidity evaporates, and how expensive hedging becomes once risk is visible. By then, protection is no longer cheap, it's scarce, just like the assets everyone suddenly wants. This is why positioning early matters. Not because disaster is guaranteed, because systems built on leverage and confidence are inherently fragile. Businesses plan for downside all the time. Cash reserves, insurance, contingency planning. Yet many portfolios operate as if stress is abstract, instead of inevitable. Preparation isn't pessimism, it's professionalism. It's the quiet advantage built long before it's appreciated. Silver, in that context, represents absence in most portfolios. It's not crowded, not overround, and that's precisely why it can become powerful when conditions shift. When investors finally realize they need exposure, they won't have patience, they'll move all at once, driven by necessity, not conviction. And that's when price accelerates and access tightens. I don't want to be forced into decisions by urgency. I want choices, because in business, optionality is everything. It allows us to respond, not react, and we gain that optionality by allocating before pressure builds, not after it's obvious. Most people wait for confirmation because it feels safer, but confirmation usually arrives with a higher price and fewer alternatives. The irony is that by trying to avoid risk, many people end up concentrating it. So at this point, everything comes down to awareness and choice. We can accept the comfort of consensus and hope familiar structures hold, or we can acknowledge that calm often precedes profound change. The most consequential decisions in investing and business are rarely made when certainty is high. They're made when signals are subtle. And conviction must come from understanding, not validation. This is one of those moments: quiet accumulation, macro strain, structural undervaluation, physical supply constraints, widespread unpreparedness. These aren't isolated factors, they're interconnected forces moving in the same direction beneath the surface, and when that expression comes, it won't ask permission, it won't wait for consensus. What matters then isn't who saw it coming, it's who acted before action felt necessary. I believe preparation is the ultimate competitive advantage. It lets us stay calm while others rush, evaluate while others react, choose while others are forced. This isn't about predicting an exact date or chasing fear-driven outcomes. It's about aligning with reality rather than narratives. Markets resolve imbalances, and they do it faster than people expect when they assume time is unlimited. When that resolution begins, the window for thoughtful positioning closes quickly, and urgency takes over. So I don't see this as a moment for bold promises or dramatic forecasts. I see it as a moment for quiet resolve, because the decisions made before pressure is obvious determine outcomes, and when pressure becomes unavoidable, history shows wealth and stability aren't preserved by those who react the fastest, but by those who prepared the earliest. The question isn't whether change will come. The question is whether you chose to recognize it while there was still time to act with clarity and intention.